morning. This is Jovine from Behind the Markets. Happy Tuesday. Today is January 7th. Tuesday, January 7th, and you'll notice that I am wearing different glasses today. I left mine at home in my rush to get out this morning. My old man used to say, you'd forget your head if it wasn't attached. Here I'm wearing these little magnifiers that I picked up from the dollar store a couple years back, and they're dirty and I can't really clean them properly, but here we are. Today I want to talk about what else but the bond market. U.S. yields hit 14-month highs before $119 billion of debt sales. This is a Bloomberg article that came out today. Basically, the 30-year bond yield has climbed to 4.85%. That is the highest level since November of 2023. Basically, the highest level since before the Fed started cutting rates. What you see here is a bond market that is basically ignoring the Fed. They can say, you know what, you can do whatever you want with interest rates. You're going to pay us more to lend you money, period. And you're going to lend us money, more short-term money. So they're forcing the Fed out of that $119 billion in debt that the government is trying to raise this week. $58 billion of it is going to be 3-year notes. And the Treasury is going to also auction 10-year notes on Tuesday, 30-year bonds on Wednesday. So here we have a situation where investors are now ignoring the Fed, which is really rare, unprecedented, really, in modern history. So what you see here, anything like this hasn't happened since the 90s, since Bill Clinton was in office, where the bond vigilantes forced fiscal control over the government, which is very good. I'm not sure that fiscal restraint's going to come this time. But why is this important? Okay, there are two reasons this is important. The 10-year bond, as I've talked to you about, the market's gone up 117% since the lows in 2020, okay? It's basically over doubled. But every time the market has gone down, it's gone down whenever that 10-year yield hits 4.5%, the market, it is like its head gets chopped off. That is like the top. The market really doesn't go higher. When that yield is at 4.5%, it pushes the market down. All the down days have come. And every time it goes above 4.5%, like 4.7%, that pushes it down. So that 4.5% level on the 10-year bond is like the ceiling for the stock market. It's going to tell you more about where stock prices are going in 2025 than anything, really. So, that tells you that there's a ceiling on the stock market, right? The other reason that it's important is that commercial real estate has been suffering, as we talked about in Midnight America last year in July. Commercial real estate has been choking to death with massive office buildings that are basically vacant, that's causing trillions of dollars of issues for banks and lenders and pension plans like CalPERS that are taking these massive write-downs. Now, the commercial real estate market have this kind of saying, survive until 25, survive until 25. You talk to anybody on Wall Street who did commercial real estate debt, you talk to anybody in commercial real estate, and they all kept saying the same thing last year, survive until 25. What they hoped would happen was that the Fed would lower rates, and that would allow them to refinance these massive buildings they have at lower rates. Guess what? That's not happening. The Fed is lowering rates, but the bond market is now in control. So these people, the Fed can lower rates to zero, but bond investors, by and large, are saying, you can lower rates to whatever you want, buddy. We're not lending you money unless you're paying us more. So we have massive headwinds. The things that we talked about, the things that we predicted last year in Midnight in America the chickens are starting to come home to roost, so to speak. And these things happen when they happen. But right now, the fiscal spending that we're doing is really starting to cost Americans money in higher rates with their mortgages, more challenges with pension funds that are going to have to take massive write-downs, commercial real estate funds that are just going to have to take massive write-downs, banks that are going to have to take massive write-downs. This is a problem that most folks aren't talking about, which is why I keep banging the bell on this one. You are watching a slow-motion car wreck. It's so sad, really. Anyway, that is all I have today. I will see you tomorrow.